of the attributes of a strong currency is to be the provider of liquidity. And while we are tied to the monetary purpose of what we do in terms of liquidity, and we have to constantly assess the proportionality of what we do, it is a fact that we are looking at our liquidity framework and that the repo line, to be distinguished from the swap lines, the repo line are in progress in terms of reframing them, opening up the access and making them more attractive to other national central banks outside the euro area and outside Europe. So this is in the works, and I hope to be able to announce a bit more in a few days. Thank you.
Next question to Francesco Canepa of Reuters. Francesco, please.
Good afternoon. So my first question is about the balance of risk. You said it's broadly balanced. Could you give us some of the flavor of the discussion? Because I don't see it in the opening statement. And the second question is about the good place. Are we still in a good place?
Thank you very much. Yeah, you will have noted, because you are an avid reader of our monetary policy statement, that we no longer state in the monetary policy statement whether the balance of risk is whether the risks are broadly balanced or tilted to the downside or tilted to the upside. We did that during the period of COVID, because we thought it was good guidance to have at the time. Now what we do as a policy and as a general practice that we have not moved since COVID is we list the upside and the downside risks component, both in relation to growth and in relation to inflation. And then it's not for you to actually second guess. There is a debate that goes on in the Governing Council, because it's always a question of judgment and collective approach to those risks and the range of the risks, the extensiveness of the risks, and that is debated. What I can tell you is that we are not seeing a reduction of the range of risks. But when I think of geopolitical risks, for instance, it's ebb and flow. When I look at uncertainty about tariffs, it's up and down and out and back. And that has been going on for quite a few quarters, actually. So no reduction of the range, but equally the sentiment around the table of the Governing Council that it's broadly balanced. Now, are we still in a good place? I would certainly argue that we are in a good place, and inflation is in a good place. Now, 2 words of explanation, because some of you might be riveted to the January data point, and I would like just to remind you that our good place is a factor of whether we are convinced that we will reach our medium-term target of 2%. And we cannot be hostage to one data point. I've said that many times. We cannot be hostage to one reading of inflation, which is set to vary over the next months. If you look at, I'm happy to go down into what's underneath, but this, 1.7, there are multiple causes. And in the monetary policy statement, we take really good care of saying what has gone up, what has gone down. You have a bit more of one category versus the others. So as a result of that, we have this particular reading. But some of them are idiosyncratic and will go away. There is a significant component on energy, which has gone from -5 point something, which has gone to -5 point something, and which is largely a base effect from last year's energy costs. But it is also a fact that inflation is moving gradually down to our target, and we see it at target in the medium term. And I would add one thing, because you didn't ask me, but no, I'll wait until somebody asks me.
Aude Kerzulek of BFM Business, please. Aude.
Good afternoon, and thank you for taking my question. Under what conditions of inflation undershooting would the ECB consider easing monetary policy? How long and how far below 2%? And on another subject, in the US, Kevin Walsh has been nominated to chair the Federal Reserve. Former central banker McCartney called it a fantastic choice. Do you share that view, and have you worked with Mr. Walsh before? Thank you.
So on Kevin Walsh, yes, I have known him for a long, long time. Back in the financial crisis days, where he was in public service, and I was Minister of Finance at the time. So we go back a long way, and I very much welcome the announcement of his appointment. Now, I just want to take you back to the undershooting. We have projected undershooting in 2026 for a long time. And if you go back to our September projections, for instance, which were the last projections conducted by the ECB, we had actually this 1.7 and the 1.8 for the entire year. So this was changed and moved up in December. In a way, we are going back to the track that we had anticipated, and this is also what markets and economists are anticipating. But if you look at our, medium-term target, which is what we rely upon, we are at 2% in 27, 2% in 28. I'm myself particularly attentive, as you know, to services. Services is declining a little bit. I'm also very attentive as a result to wages. We have the wage tracker, which seems to guide us towards more growth moderation. We will have more data and intelligence coming out of the March exercise, but there is nothing that is really changing the baseline at all. And we, as I said, be looking at all data, not one single data point.
Olaf Storbeck of the Financial Times, please.
Thanks for taking my questions. My first question is on kind of making sense of the mood music in the monetary policy statement. Some analysts noted that it seems to have a bit of a hawkish subtext, because you're kind of emphasizing the positive elements and kind of also emphasizing that inflation is on track to meet your target. Would you share that view, that it's kind of, well, more hawkish than dovish? My second question is on core inflation, which has fallen to, I think, the lowest level since October 2021, and is also below the ECB's Q1 forecast. Does the governing council see this as a good development, as it kind of suggests inflation is coming down further and quicker than potentially expected, or is this seen as a rather kind of negative trend because disinflation might be stronger than you want it to be? Thanks.
Thank you for your two questions. So on your first question, I would like to mention that our monetary policy is in good shape. And it's in good shape because it is agile, and it is prepared to do what is necessary in order to reach our medium-term 2% targets in a symmetric way, as we decided in our strategy assessment determination back in July 2025. So I'm not trying to characterize the hawkishness or the dovishness. This is something that you enjoy doing and that markets look at very attentively. But we are data dependent. We will decide meeting by meeting. We are not rate path predetermined. We do not give forward guidance. We are in this world of significant uncertainty, where geopolitics developments determine a lot of developments, and that's what we're going to continue doing. Core inflation, you're right. It's one of the underlying inflation elements that we consider. That is one which has gone from 2.4 to 2.2. We're still at 2.2, by the way. And I think that it's following a path that we had anticipated, that we are pleased to see is taking us to targets. I would like to emphasize one element, which you will allow me to pick up because I think it might be interesting. As you probably know, the leaders are meeting in a week's time to examine competitiveness, reforms, and hopefully to accelerate the process. So in our monetary policy statement, as you well know, we always have this paragraph, which has slightly evolved over the course of time, in which we stress the urgent needs to strengthen the euro area and its economy in the present geopolitical context. And you generally look at this paragraph and say, okay, still the same thing. So what we decided to do in anticipation of that meeting on the 12th of February is to actually give our checklist to the leaders. So I will send it to each of the leader of the European Union, to the President of the European Commission, and to the President of the European Council. And this is our checklist of what we regard as very much likely to enhance growth, to improve productivity, and to really unleash the talent of Europe. We're not, shooting above our range, but we believe that whether it's the savings and investment unions, the digital euro and the tokenized wholesale central bank money, the deepening of the EU single market, the fostering of innovation and protection of open strategic autonomy, or simplifying legislation and strengthening core institutional framework, on these 5 accounts, we hold views. We cannot deliver it all. We are delivering monetary policy and compliance with our mandate. But we strongly feel that significant reforms have to be either deepened, accelerated, in order to deliver on what is the potential of Europe. So that's something that I thought I would mention.
Stefan Recchius of Handelsblatt, please. Stefan.
Thank you. Good afternoon. I have a follow-up on the global euro debate, in particular with regard to Eurobonds. So you checked a few items that you think are important, but what about common defense spending as a critical element in this regard? Is it sufficient in terms of a global euro, or should the EU be even bolder when it comes to Eurobonds and making it a permanent feature of a euro safe asset? Thank you.
Well, thank you for your question, and it is definitely part of our checklist.
And now Chelsea Dolani of the Wall Street Journal. Chelsea, please.
Thank you for taking my question. So today's statement talked about the low employment rate, but if you look at some of the other indicators of labor market resilience, they seem to be telling a slightly different story. Things like labor demand, hiring intentions, vacancy rate. So I'm wondering how you're balancing these different signals. Is the labor market potentially weaker than it may appear based on the unemployment rate? And I also wanted to ask about AI. I think you've mentioned a couple times that we are seeing this benefit of AI investment in Europe, but I think in the global context, there is this concern that Europe's falling behind, whether that means adoption or data center investment. So I was just wondering if you could shed a little more light on what the benefits we are actually seeing in terms of the economic impact in Europe and how that might impact broader growth.
Thank you for your 2 questions. So, on the labor market, we are seeing, first of all, a lot of the data that we get on labor and the labor market in its various dimensions, you referred to vacancies and rotation, are a bit backdated. So very often in January, we look at data that we get from the 3rd quarter, some of it from the 4th, but it's generally with a lag. What we are seeing is increased participation in the labor market. We are seeing slightly lower unemployment, 6.2 coming from 6.3. We are seeing vacancies that are growing more moderately than we had in the past. And it's a labor market that is still active. As I said, where unemployment is almost at rock bottom. So we will continue to pay close attention because obviously it has an impact on particularly the wage negotiations that we pick in our wage tracker to try to understand where salaries, where the drift is going, which is the difficult part to determine, where the one-offs are likely to arise as well. So that's what I can tell you about the employment. But we're certainly not saying that the labor market is in difficulty. On AI investment, you know, one of the good news story as far as the European economy is concerned is that while the net export activity and contribution to growth is on the decline, the domestic market is responding strongly. Consumption is improving a little bit, but not much. But investment is the big story. And whether you look at public investment, particularly in defense and infrastructure, and as a result, well, I'll come to that in a second. Construction is also a derivative of infrastructure investment, but it's not just the public sector, it's also the private sector. We see significantly higher number in terms of private sector investment. And that is particularly the case in what I used to call ITC or ICT, which I think we have to be a bit more granular about because it's AI related, but it's everything having to do with AI. So it's not just AI, it's the infrastructure that comes with it. So construction of data centers in the pipeline and going through the process of licensing and authorization. It's software, it's hardware, it's a lot of investment that is coming out of that particular segment. The really interesting thing from our perspective is how it will impact productivity and how it will contribute or not to inflation, depending on the level of improved productivity. There is a little bit of that, but it's going to take a while to unleash.
Thank you. That concludes our press conference today. So we will see each other again, if you want, on the 19th of March. And up until then, all the best. Thank you very much.